Welcome to your deep dive on achieving, well, financial unshakability. You've been digging into Tony Robbins' Unshakeable, right?
Feels like it.
Awesome. We're going to unpack a ton of financial wisdom from it today. Ready to dive in?
Absolutely. Let's go.
So it's kind of a no-brainer, but the economic climate, it's got like everyone feeling a little shaky about the future.
For sure.
Robbins actually kicks off Unshakeable with this interview with Alan Greenspan, former Federal Reserve Chairman, the whole 9 yards.
Yeah.
And when Robbins asked him, what would you do if you were in charge of the Fed right now?
Oh, I remember this.
Greenspan's response, resign.
Yikes, right?
It makes you wonder if the guy who basically steered the U.S. economy for, almost 2 decades would just throw in the towel?
Right.
Where does that leave, the rest of us?
It really sets the stage for why so many people are feeling anxious, about their finances.
Totally.
But what Robbins keeps hitting on is that during times like these, with all this uncertainty swirling around, it's actually the perfect time to build an unshakable mindset.
I love that. So less about market predictions and more about building that inner confidence to just navigate whatever comes your way.
You got it. It's about going from reacting out of fear to being proactive, being empowered.
And it's kind of interesting. Robbins donated all the profits from the book to Feeding America.
Oh, wow.
It's like it goes beyond just talking about money.
Yeah.
He's actually using it for good.
Absolutely. And, that actually leads perfectly into one of the most basic principles of building wealth, the power of compounding.
Right.
Robbins has this story about Joe and Bob. They both invest the same amount, but Joe starts 8 years earlier.
Oh, yeah. And then by the time they're both retired, Joe ends up with way more.
Way
more. Even though technically he put in less money overall. It's crazy how those early years.
It really highlights how important those early years are.
Makes such a difference.
Okay, so let's say they each invested $5,000 every year, right? And let's say they got an average return of 7%.
Okay.
Bob, he invests for 32 years, ends up with around $693,000.
Not bad.
Not bad at all. But Joe, he started just 8 years earlier.
Yeah.
He ends up with over $1.1 million.
Wow.
It's a huge difference.
That's a huge EE difference. You're basically front-loading the growth potential?
Exactly.
It's simple when you think about it, but seeing the numbers like that,
it makes it really...
It's kind of mind-blowing.
That's how you build wealth while you sleep. Time becomes your secret weapon.
So we know starting early is key, but then there's always that fear in the back of your mind, market crashes, corrections, all that.
Right.
How does Robbins address that?
He lays out these 7 key facts. They're based on over a century of market history. It's all about grounding us in reality, not letting our emotions run wild.
Okay, I like it. Hit me with those facts.
All right, so fact number 1. This one usually surprises people.
Okay.
Corrections where the market dips 10% or more. Super common, actually. Really?
And most of them don't even turn into full-blown bear markets.
So it's all those scary headlines about the market dropping, they're more like blips on the radar?
Exactly.
Right.
Robbins points out that almost 80% of corrections they fizzle out. They don't become those long, drawn-out downturns.
So it's just normal market behavior.
Pretty much.
Okay, that makes sense. What's another one of these facts that can help us, not freak out and make rash decisions?
Fact number 2 is that no one, and I mean no one, can consistently predict what the market's going to do.
Oh, man.
All those financial gurus on TV making those bold predictions.
Yeah.
Robbins says, tune them out.
Okay.
Because even the so-called experts, they get it wrong all the time.
So instead of trying to time the market perfectly,
forget about it.
What should we be focusing on?
The long game. Fact number 3, the stock market. It's always gone up over time.
Right.
Despite all the ups and downs, the overall trend is up.
This ties into that whole unshakable mindset, doesn't it?
100%. It's about trusting that upward trajectory even when things get a little bumpy.
Exactly. So Robbins gives this example. From 1980 to 2015, the S&P 500, it had an average intra-year decline of over 14%.
Wait, so every year?
Every year.
There's a drop of over 14% at some point.
Usually, yeah.
That's a big drop.
It is. But here's the thing.
Yeah.
The market still ended positive in 27 of those 36 years.
Huh.
So, yeah, we have bear markets, but fact number 4 is that they always recover.
It's reassuring to see those historical trends.
Right.
Makes you less likely to, panic when things go south.
And that leads to fact number 5.
Yeah.
If you miss the market's best days, you're really missing out. Because those best days often happen right after a dip.
So if you panic and sell during a downturn, you could miss the rebound that follows.
Exactly.
Yeah.
It's like Robbins says, the market is a device for transferring money from the impatient to the patient.
That's a good one.
And then fact number 6, time in the market beats timing the market. Even if you buy at what seems like a bad time, staying invested is key.
It's a good reminder. Okay, 6 tacks down. What's the last one?
This one's important. Fact number 7, the biggest threat to your financial well-being.
Yeah.
It's not a market crash. It's being OUT of the market.
Don't let fear keep you on the sideline.
Yeah.
So we've talked about staying invested, but then Robbins also pulls back the curtain on this kind of hidden enemy fees.
Oh, yeah.
He says most people don't even realize how much they're paying, and those fees can really, chip away at your returns over time.
It's kind of crazy, actually. Robbins mentions the study that found that over 70% of Americans, they think they don't pay any fees for their 401k plans.
No way.
And get this, 92% admit they have no clue how much they're actually paying.
So they're just blindly trusting the system.
Seems that way, but Robbins, he argues it's like handing over your wallet and just hoping for the best.
So where are these hidden fees lurking? Where do we need to be careful?
One of the main culprits is actively managed funds. The ones that are always promising to beat the market.
Yeah.
Studies show that most of them actually end up doing worse than the S&P 500 after you factor in those fees.
So they're basically taking their cut whether they win or lose.
Pretty much.
What about Warren Buffett? Doesn't he have something to say about this?
Yeah. Even Warren Buffett, who's arguably the greatest investor of all time,
Right.
he consistently tells people, stick with those low-cost index funds.
That's a pretty strong endorsement.
It is. And, fees, they're not just in actively managed funds.
Oh, right. What about 401ks?
Ugh, the 401k system. It's riddled with them.
What?
For years, companies didn't even have to tell you about these fees.
Seriously?
It's only since, 2012 that we've had more transparency.
Okay.
But even now, the documents, they're so confusing.
It's designed to trip you up.
Right. So it's still really easy to fall into this fee trap.
So how much are we actually talking about here? What's the impact?
It can be huge.
Really?
Robbins talks about a study where they looked at a typical 401k plan.
Okay. And found that it could be costing people, get this, up to 3.5% per year in fees.
3.5%. That's a huge chunk of your money.
It is. And those are just the fees they tell you about.
Oh, no. There are more.
Oh, yeah. There are all sorts of hidden fees tucked away.
Like what?
For example, a 401k provider, they might take payments from these mutual fund companies just to include their funds in the plan.
It's like a bribe.
It is.
Yeah.
To push these overpriced funds. And they might not even be right for you, the participant.
Okay, so how do we protect ourselves from this?
Well, that brings us to financial advisors. Specifically, finding one who is a fiduciary.
Right, because they're legally obligated to.
Put your interests first.
Okay, so finding the right advisor, that's key.
Absolutely. And that's something we'll dive into next time. We'll explore the different types of advisors and how to find one who's really got your back.
All right, so we're back and ready to tackle this whole financial advisor thing.
Yeah.
It's kind of overwhelming. There are so many different types of advisors, different titles.
Right. Designations, where do we even start?
Robbins actually breaks it down pretty nicely.
Okay.
He says there are 3 main categories. You've got your brokers, your registered investment advisors, RIAs,
Okay.
and then these kind of hybrid advisors who can actually be both.
Okay, so let's break those down a bit. Let's start with brokers.
Right.
What makes them different?
Brokers, they're basically salespeople.
Okay.
They make money by selling you financial products. So their incentive is to close deals,
Right.
even if it might not be the best thing for you.
So their interests might not always line up with mine as the client.
Exactly. Robbins has this analogy. He compares it to going to a doctor who gets paid more for prescribing certain medications.
Oh, I see.
You would always be wondering, are they recommending this because it's the best treatment
Right.
or because they're getting a kickback?
Yeah.
Yeah.
Makes sense. Okay, so then what about these registered investment advisors? The RIAs.
RIAs are legally obligated to be fiduciaries, which means they're bound by law to put your interests first,
Okay.
even if it means they make less money.
So they're like the doctor who recommends the most effective treatment, even if it's the cheaper generic option.
You got it. But, and this is where it gets tricky,
Uh-oh.
there are these hybrid advisors.
Right, you mentioned them.
They can wear both hats. They can act as a broker and an RIA.
Wait, so they can switch depending on the situation?
Yeah, it's confusing. And even if an advisor is technically a fiduciary, there can still be conflicts of interest.
Oh, really?
Like some firms manage their own mutual funds,
Yeah,
so they might push those funds even if there are better options out there.
because it benefits them.
Exactly. Robbins says another red flag is when advisors take consulting fees from mutual fund companies.
Right, so they're getting paid by the client, Andy, the fund company?
Yep.
That doesn't seem right.
It's a hidden form of compensation that can definitely cloud their judgment. That's why it's super important to ask the right questions up front when you're interviewing potential advisors.
Okay, so what are the right questions? What should we be asking?
Robbins has some good tips on this. First off, look for an advisor who specializes in what you need.
So, if I'm focused on retirement planning,
Yeah.
I should find someone who really gets that.
Exactly. You wouldn't go to a foot doctor if you had a heart problem.
Right.
It's the same with financial advice. You want someone with the right expertise.
Okay, makes sense.
And then you want to look at their experience, their track record.
Yeah.
Have they actually helped people in similar situations to yours?
Have they actually practiced what they preach?
Exactly.
What else?
You want to make sure you're aligned philosophically, too.
What do you mean?
Does this advisor believe in trying to beat the market? Or do they favor a more, diversified approach?
Right. Index funds and things like that.
Yeah, exactly. You want to be on the same page,
Yep.
investment-wise.
Okay, that makes sense.
Yeah.
And I guess I would also want someone who's actually, invested in my Randall success, not just trying to, churn accounts and make a quick buck.
Totally. You want someone who actually cares about educating you, empowering you. They should explain things clearly, answer your questions, help you really understand what's going on.
So it's a partnership.
It is. And Robbins also talks about how beneficial it is to have a team approach.
Oh, interesting.
Ideally, your advisor has access to specialists in different areas,
Yeah.
taxes, estate planning, insurance, all that stuff.
So you're covered on all fronts.
Right.
Okay, so let's say we found this awesome, trustworthy advisor who really gets us.
Awesome.
What are some of the key investment principles they should be guiding us with?
Robbins outlines 4 main ones that all the top investors use.
Okay.
And these actually connect back to finding the right advisor because a good advisor will help you actually implement these principles.
Got it. Okay, let's hear them. Principle number 1.
This one sounds super basic, but it's crucial. Don't lose money.
Well, yeah, obvious.
I know it seems obvious, but you'd be surprised how many people get caught up chasing returns and end up taking on way more risk than they can handle.
That's true.
Now, this doesn't mean you avoid risk completely.
Right.
It's about managing it, being smart about it, especially when the market takes a dip.
So how do we do that? How do we avoid those big losses that can, set you back for years?
One thing Robbins does is he looks for undervalued assets. Especially when everyone else is freaking out. He talks about how he invested in first trust deeds during the 2008 crash.
First trust deeds. Remind me what those are again?
They're basically short-term, high-interest loans that are secured by real estate.
Okay.
So when the market crashed, property values tanked.
Yeah.
And Robbins saw a chance to buy these loans at a discount.
Because everyone else was panicking.
Exactly. And as the market recovered, the value of those loans went up.
So he made a killing. He basically capitalized on the fear.
He did.
Interesting. Okay, principle number 2.
This one builds on that idea of managing risk. It's all about aiming for what's called asymmetric risk reward.
Asymmetric risk reward.
Yeah.
What does that mean?
It means you're looking for investments where the potential upside is way bigger than the potential downside. It's like heads I win, tails I don't lose much.
I like that. So give me an example. How does this work in the real world?
Robbins really likes these things called master limited partnerships, or MLPs.
Right.
They're publicly traded partnerships that mostly invest in energy infrastructure,
Okay.
like oil and gas pipelines.
Not your typical stock then.
Right. And one thing that makes them attractive in terms of that asymmetric risk reward is that they usually pay out consistent dividends. It doesn't really matter what's happening with energy prices.
So even if the price of oil drops, you're still getting that steady income.
Exactly. And if energy prices go up, you have the potential for some pretty sweet gains.
Makes sense. Okay, what's principle number 3?
Principle number 3 is all about being tax efficient.
Ah, yes. Taxes.
It's not just about how much money you make, it's about how much you get to keep after the tax man takes his share.
Right, right. Taxes can eat away at your returns like crazy.
For sure. So one strategy is to max out those tax-advantaged accounts, like 401ks and IRAs.
Yeah?
Your investments can grow tax-deferred in those.
Yeah, okay. Anything else?
Robbins also likes municipal bonds because the interest is often tax-free.
So there are definitely ways to, like, strategically reduce your tax burden.
Definitely. And Robbins even talks about some more, advanced techniques,
Great.
like using trusts to minimize estate taxes.
This is where it gets complicated.
Yeah, and this is definitely an area where a good advisor can be super helpful.
Okay, so much to think about. What's the 4th principle?
Principle number 4 is all about diversification.
Don't put all your eggs in one basket.
Exactly. Diversifying helps you manage risk. You're basically spreading your investments across different things.
Like stocks, bonds.
Stocks, bonds, real estate, and even stuff like gold or commodities.
Right. So if one area is down, another one might be up.
Mm-hmm.
Kind of buffers the impact.
Exactly. And Robbins really emphasizes global diversification, too.
Amazing.
Invest all over the world, not just in your own country.
So you're not tied to just one country's economy. Smart.
Right. And this is where asset allocation comes in.
Okay.
Figuring out what percentage of your portfolio should be in stocks, bonds, real estate, and so on.
That sounds pretty complicated.
It can be. It depends on a lot of things. Your risk tolerance, how long you're investing for, your financial goals.
So someone who's younger and saving for retirement, like way down the road,
Right.
they might have more in stocks than someone who's, closer to retirement.
Exactly. And Robbins actually debunks that old rule of thumb about your age determining your stock allocation. He says it's too simplistic. You need a plan that's tailored to you.
So like a 65-year-old who's in great health and expects to live a long time, they might not need a super conservative portfolio.
Right. It's not one size fits all.
So many things to consider. I'm seeing why a good advisor would be so valuable.
They can definitely help you create an asset allocation strategy that actually aligns with your needs and goals.
Okay, so we've got compounding, staying invested for the long haul, watching out for those fees, and these 4 core investment principles. But it feels like we've mostly been focusing on the practical side of things, the strategies.
Yeah.
But investing, it's not just about numbers, right?
It's not. There's a whole psychological side to it.
Exactly.
Yeah.
So how does Robbins address that?
Well, he has a whole section in the book about what he calls taming the inner enemy. He says even if we have all the right knowledge, the right tools, our own psychology can really mess things up.
Oh, yeah, for sure. I've definitely been my own worst enemy when it comes to investing.
We all have.
Okay, so let's talk about those inner enemies. What are some of the things we need to watch out for?
One of the most common is something called recency bias.
Recency bias?
Yeah, it's this tendency to put too much weight on recent events when we make decisions.
Okay.
Even if those events, they don't really reflect the long-term trend.
So if the market's been going up for a while, I might get, like, overconfident
Right.
and assume it's just going to keep going up.
Exactly. Or the opposite.
Oh, wow.
If the market's been going down, we might panic and sell everything, even though historically, those downturns are followed by upswings.
Right. So like we get so caught up in the emotion of the moment, we forget about the bigger picture.
Exactly. And then there's overconfidence.
Oh, boy.
Which can lead to some pretty big mistakes when it comes to investing.
Like what?
Like thinking we're smarter than the market and trying to outsmart everyone else.
Yeah.
But studies show that even professionals, they struggle to beat the market consistently over the long term.
So a little humility goes a long way.
It does. Robbins tells this funny story about a study where they asked a bunch of student drivers if they thought they were above average.
Right.
93% of them said yes.
So we all think we're better than average,
Yeah.
even though, like, statistically that's impossible.
Exactly. And this overconfidence, it can lead us to, like, trade too much.
Yeah.
Take on too much risk.
Right.
And just shoot ourselves in the foot.
So how do we combat this stuff?
A big part of it is just awareness. Knowing that these biases exist, that we all have them.
Right.
And then it's about having strategies to, to minimize their impact.
Like having a solid investment plan and sticking to it.
Exactly. Even when things get crazy in the market.
Yeah.
It takes discipline to not give in to those urges to buy high and sell low. Robbins also says it's good to, like, get different perspectives, challenge your own assumptions.
Don't just surround yourself with yes men. Talk to people who might see things differently. Makes sense. So we covered a ton of ground here, but it feels like we've been focusing on the nuts and bolts of finance.
Yeah.
But what about the emotional side of all of this? How does Robbins address that in the book?
Well, that actually leads us into the final part of our deep dive.
Oh, perfect.
Robbins argues that true wealth, it goes beyond just money.
Okay.
It's about living a fulfilling life, feeling joyful, making a positive impact on the world. He calls it living in the beautiful state.
I love that. It's not just about the numbers, right?
Right.
It's about living a rich and meaningful life. Okay, I can't wait to explore this beautiful state idea. All right, we're back for the final part of our deep dive into Unshakeable. We've covered a lot, from those sneaky fees to the power of compounding.
Yeah.
But now I'm really excited to get into this idea of the beautiful state.
Yeah.
It feels like we're shifting gears from the nuts and bolts of finance to something deeper.
Exactly. Robbins makes this really interesting point.
Okay.
He says, true wealth, it's about way more than just money.
Yeah.
It's about, living a fulfilling life, feeling joyful, having a positive impact on the world.
I love that.
He calls it living in the beautiful state.
Okay, so tell me more about that. What's the difference between living in this beautiful state versus, I guess, not?
Well, think about the beautiful state as this place filled with love, gratitude, excitement, passion, that feeling of being truly alive and having a purpose.
Got it.
Then you have what he calls the suffering state.
Uh-huh.
That's where fear lives, anxiety, frustration, resentment.
So that's that feeling of being stuck, overwhelmed, just generally unhappy.
Exactly. And Robbins says that in each moment, we have a choice.
Mm.
We can feed the beautiful state by, focusing on what we appreciate.
Right.
Or we can slip into the suffering state by dwelling on all the negative stuff.
So it's about taking control of your thoughts and emotions rather than letting them control you.
Exactly. And he makes it clear that it's not about denying or suppressing negative emotions. It's more about acknowledging them.
Okay.
And then choosing to shift your focus to something more empowering.
Okay, so that sounds good in theory, but how do we actually do that?
Yeah.
Especially when life throws those curveballs our way.
Robbins has some great tools for that. One of my favorites is what he calls the 90-second rule.
The 90-second rule.
Yeah. It's this simple technique for stopping those negative thought spirals.
Okay.
So when you feel yourself, slipping into that suffering state,
Yeah.
Robbins says, just give yourself 90 seconds to actually feel that emotion.
Really?
Don't resist it. Just let it flow through you. But then after those 90 seconds, you consciously choose to focus on something you appreciate.
So instead of dwelling on the problem, you actively look for something to be grateful for.
Exactly.
Even if it's something small.
Even if it's something small. It
Yep.
could be anything. A sunny day, a good cup of coffee, a phone call with a friend.
Right.
Anything that gives you that sense of joy or peace.
It's like retraining your brain to focus on the good.
It is. And Robbins explains that this little shift in focus, it can really have a ripple effect. Positive thoughts lead to positive feelings, which often lead to positive actions.
So it creates a more positive spiral.
Exactly.
Not just with your finances, but just in life.
Right.
Are there other techniques he talks about for cultivating this beautiful state?
Yeah. He also talks about the power of something called heart coherence.
Heart coherence.
It's this state where your heart rate variability is smooth and rhythmic. It's basically when your heart and brain are in sync.
Okay, so how do we achieve that?
There are certain techniques you can do.
Okay.
Robbins walks through this really simple meditation. You focus on your heart, you breathe deeply, and you cultivate these feelings of appreciation, love.
So you're consciously creating this inner harmony.
Exactly. And studies have actually shown that heart coherence has all these benefits, like it reduces stress, boosts your immune system, improves your emotional well-being.
Wow, it sounds like it's good for everything.
It is. But, even if we're in this beautiful state, life is still going to have its ups and downs.
Right.
Robbins isn't saying we should, ignore reality or pretend everything's perfect.
Okay.
It's more about choosing how we respond to those challenges.
So having the resilience to go through those tough times without letting them completely derail you.
Exactly. And he tells this amazing story about Alice Hertzsummer. She was this brilliant pianist who survived the Holocaust. Even in a concentration camp, she found ways to keep her spirit alive, to find beauty in the smallest things.
It's a good reminder that our mindset, it's a choice, no matter what our external circumstances are.
And that's really what true wealth is about, isn't it? It's about cultivating that inner richness that can't be taken away,
Yeah, I love that.
no matter what happens with the markets or anything
It
else.
reminds me of that quote Robbins shares, "Success without fulfillment is the ultimate failure."
Such a good quote. It's a good reminder that we should be striving for both financial security and a life filled with joy and purpose.
This has been an awesome deep dive into Unshakeable. We've covered so much from, the nitty-gritty of investing to this deeper exploration of what it really means to live a rich life.
It really is a great book. It gives you a roadmap to achieve both.
You know what really got to me?
What's that?
That story about Alice Hurt's summer. Finding beauty in a concentration camp, just incredible. It shows you that our mindset, we do have control over it, no matter what.
It's a truly inspiring story, and it really reinforces the message of the book. True wealth is about inner peace, resilience, and that deep sense of gratitude for the good in our lives.
Absolutely. Well, we've shared our takeaways. Now we want to hear yours. What are your thoughts on this deep dive into Unshakable?